There is a number that almost no one knows. In 1999, George Soros lost approximately $700 million in a single quarter, not in a slow decline, not across a decade of bad decisions, in roughly 90 days during a period when most investors around him were making the easiest money of their careers. He was one of the most respected investors alive. He had 50 years of experience. He had a framework that had survived currency crises, market crashes, and geopolitical earthquakes. And he lost $700 million because he made a mistake that, when you examine it closely, is the same mistake most ordinary people make with their savings every single year. That is mistake number 2, and we will get to it. But first, mistake number 4. I am telling you about it now because it is the one that changed how Soros thought about money entirely. Not the losses, not the public embarrassment. The 4th mistake is the one that happens not when things are going wrong, but when everything is going exactly right. And it is probably the most dangerous financial error a person can make. Stay for that one. Everything before it is context. Everything after it is consequence. This video is not about George Soros' wins. His wins are well documented. The $1 billion, the pound, the single day in 1992 that made him famous in every financial capital in the world. This video is about the 5 mistakes, what they were, what they cost him, and what he understood afterward that most people never figure out, even after a lifetime of trying. Now, before the mistakes, you need to understand one thing about how Soros thought about being wrong. Most people treat a mistake as an ending, something to be ashamed of, minimized, explained away. They spend enormous energy making sure other people do not see it. They hold losing positions longer than they should because closing the position makes the loss official. They tell themselves the market will come back. They wait. And while they wait, the loss gets larger and the lesson gets buried under the weight of hope. Soros did the opposite. He treated every mistake as data, not pleasant data, not the kind of data you want to receive, but the most valuable kind, the kind that tells you exactly where your model of the world diverges from reality. He said it himself more than once. My approach works not by making the right calls, but by recognizing my wrong calls faster than everyone else. This is the frame. Hold it in your mind as we go through each mistake. Because the mistake itself is never the most important part. What he did in the 24 hours after the mistake is what made him extraordinary. The first mistake happened not when Soros was old and famous and managing billions. It happened early in the 1960s, before most people knew his name, when he was still building his reputation and had far more to lose than he had to gain. He made a series of bets on European stocks, particularly in certain industrial sectors, based on a thesis he had developed through months of research. The thesis was careful. The reasoning was sound. The position was large relative to what he was managing at the time. And then nothing happened. Not a loss at first. Just nothing. The stock sat still. The thesis did not play out. Month after month, the market showed no sign of recognizing what Soros believed was obvious. Other positions were performing. Capital was tied up in something that had stopped moving. Most investors in this situation hold on. They tell themselves patience is a virtue. They wait for the market to catch up to their intelligence. Soros exited, not because the thesis was proven wrong. It had not been proven wrong. He exited because time is a cost. Every month capital sits in a position that is not working, that capital is not working somewhere else. The opportunity cost of patience is not zero. It is everything the money could have been doing instead. He called this the cost of being too early, and he concluded that too early and wrong are, for practical purposes, identical. If the market does not confirm your thesis in a reasonable window, the thesis is either wrong or it is irrelevant. Either way, the position should be closed. Now consider what this means for your own financial life. Think about the last time you held something, an investment, a career path, a business idea, longer than you should have. Not because it was working, but because you were certain it would eventually work. Certainty is not a strategy. The market does not reward certainty. It rewards timing. And timing includes knowing when to stop. Thomas held a rental property for 6 years that produced no meaningful returns. He was certain the neighborhood would improve. He had done the research. He had a thesis. Everywhere he told himself next year would be the year the market recognized the value he had identified. By year 6, the property had cost him more in maintenance and opportunity cost than any reasonable return could justify. He had not lost money in the way that shows up on a statement. He had lost something harder to measure. 6 years of capital that could have been moving, compounding, building somewhere else. William made the same type of investment, found himself in the same situation after 18 months and exited. He did not wait for the thesis to be proven wrong. He waited for a reasonable confirmation window, found none, and moved the capital to something that was actually moving. 3 years later, Thomas's neighborhood had still not turned. William's redirected capital had doubled. Too early and wrong are identical. This was Soros's first lesson, and he never forgot it. The second mistake is the one most financial publications mention when they want to make a point about humility. It happened in 1999. You already know the number $700 million. Now here is the story behind it. The technology bubble was building. Internet companies with no revenue, no profits, and no coherent business model were being valued at figures that had no relationship to any traditional measure of worth. Soros knew this. He said it publicly. He wrote about it. His entire framework, the understanding that markets move in self-reinforcing loops until they break, told him that this loop would break violently and soon, so he bet against it. And for a period of time he was right in theory and catastrophically wrong in practice. The bubble did not break soon, it kept going. The stocks he had shorted kept rising. The losses mounted. His flagship quantum fund hemorrhaged hundreds of millions of dollars. His chief investment officer resigned. The press, which had spent decades celebrating his genius, began writing the kinds of articles that appear when someone important begins to look fallible. And then after absorbing those losses, after publicly acknowledging that the short positions had been wrong, Soros did something that almost no one predicted. He switched sides. He decided that if the loop was going to keep running, he would run with it. He took long positions in the very technology stocks he had been betting against. He joined the bubble he had been fighting. For a brief period, this worked. The fund recovered some of what it had lost. And then the bubble broke. March 2000. The collapse was exactly what Soros had originally predicted. But because he had switched sides near the top, the quantum fund lost nearly $3 billion in the first half of 2000. It was one of the largest single-period losses in the fund's entire history. Stop and think about what actually happened here. Soros was right about the bubble. It was right about the collapse. It was right about everything except the timing. And the timing cost him $3 billion and his reputation for a period of years. The lesson he extracted was not what most people assume. He did not conclude that he should have stayed with his original short position. He did not conclude that patience would have rewarded him. He concluded something more precise and more uncomfortable, that being right about the direction is worthless without being right about the timing, and that the ego investment in a correct thesis is more dangerous than the financial investment itself. He had switched sides not purely because of logic. He had switched sides partly because the public losses of his short position had created pressure, internal pressure. The pressure of being seen as wrong, the pressure of watching other people make money on something you have publicly called a bubble. He allowed ego to contaminate a framework that was supposed to be ego-free. This contamination cost $3 billion. Most people who hear this story think, I would never make that mistake. But they make a version of it every time they abandon the sound, long-term decision because of short-term social pressure. Every time they buy something because everyone around them is buying it. Every time they hold something past the point of logic because selling means admitting publicly that they were wrong. The ego investment in being right is always more expensive than the financial investment in any single position. The third mistake is quieter than the others, less dramatic. No headlines. In some ways, it is the most instructive because it is the mistake that most closely resembles what ordinary people do with their money every single day. In the mid-1980s, Soros built a significant position based on a macro thesis about the relationship between the US dollar and the Japanese yen. The thesis was grounded in careful analysis. The position performed well initially. Then it began to underperform. Then it moved against him. What he did next is what makes this mistake worth examining closely. He did not exit immediately. He reviewed the thesis. He consulted his team. He found reasons the thesis was still valid. He made small adjustments to the position rather than closing it. He rationalized. Rationalization is the enemy of every investor who has ever made money and then tried to keep it. The mind, when faced with a losing position, does something automatic and almost invisible. It begins searching for evidence that the position is still correct. It finds that evidence, because in any complex situation there is always some evidence available for any conclusion you want to reach. It presents that evidence to itself as objective analysis, and it uses that analysis to justify holding longer than the rules allow. This is not weakness. This is not stupidity. This is how human brains are built. The same cognitive machinery that makes people good at finding patterns and constructing narratives works directly against them when the narrative involves their own money and their own judgment. Soros eventually exited the position, but he exited later than his rules said he should have, because in the intervening period he had allowed rationalization to override the system he had built precisely to prevent that from happening. He came to believe that intelligence is a risk factor in investing, not because smart people make bad decisions, they often make very good ones, but because smart people are exceptionally good at constructing convincing justifications for whatever they already want to believe, and the more sophisticated the justification, the longer the bad position survives. Thomas watched his stock portfolio decline for 7 months. Every month he found a reason it would recover. A new product announcement, a management change, an analyst upgrade. Each reason was real. Each reason was also a story he had constructed to avoid doing what his own rules told him to do. By month 7, the loss had grown from manageable to painful. William had a rule, one rule. If a position declines beyond a specific threshold without a fundamental reason tied to the original thesis, he exits. Not reviews, not consults, exits. He exited the same stock in month 2. He redeployed the capital. He did not watch the recovery that never came. Build a rule, follow the rule. Do not negotiate with the rule when the position is losing. The intelligence that built the thesis will betray you when you ask it to evaluate the thesis under pressure. The fourth mistake, this is the one I told you to wait for. In 1992, the same year he broke the Bank of England, the same year he made over $1 billion in a single day, George Soros was also wrong about something else, something large, something that, if it had gone differently, could have erased a significant portion of the gains from the pound trade. He had built positions in German bonds and other European instruments based on a thesis that the resolution of the currency crisis would play out in a specific way across multiple markets simultaneously. The pound trade was one piece, but he had several other pieces on the board at the same time. Some of those pieces did not work. Most accounts of 1992 focus only on the pound. The $1 billion win is the story everyone wants to tell, but Soros grossed meaningful sums on other positions in the same period. Positions he had sized based on the confidence generated by the pound thesis, positions that were connected to a broader view that did not fully materialize. The lesson he later articulated was about what he called the danger of the winning feeling. When one position works exceptionally well, it creates a psychological state that is almost indistinguishable from competence, but is actually something entirely different. It is confidence that has been decoupled from analysis. It is the feeling of being right generalized into a belief that you are currently seeing clearly across all positions, when in fact you are only seeing one position clearly, and the glow from that position is illuminating everything else with a certainty that has not been earned. This is the mistake that is hardest to see coming, because it does not arrive during a loss. It arrives during a win, when everything feels correct, when the thesis has just been validated in the most dramatic possible way, when it seems impossible that you could be wrong about anything right now. That is precisely the moment to slow down, to return to First principles, to ask not what else should I be doing with this momentum, but what would I think of this decision if I were making it yesterday before the win. The pound trade made Soros famous. The mistakes he made in the same period, riding the confidence of the pound trade into positions that had not been analyzed with the same rigor, are the ones that made him wise. William understood this not from trading currencies, but from his own career. He had spent 3 years building a skill that the market rewarded generously. When the reward arrived, he made 3 new bets in quick succession: career moves, investments, commitments, driven not by the careful analysis that had produced the original success, but by the feeling of momentum. 2 of the 3 did not work. The one that worked was the one he had analyzed before the winning feeling arrived. Thomas made the same pattern of decisions in the same period. All 3 of his new bets failed, not because he was less intelligent than William, because he did not know that the winning feeling is a separate thing from the winning analysis. They feel identical from the inside. They produce completely different results. When you are succeeding, the most dangerous question you can ask is, what else should I be doing right now? The correct question is, what would I think of this decision if I had made it before the last win? The 5th mistake is the most recent, and it is the most human. In 2008, George Soros came out of a period of semi-retirement to manage money again. The financial crisis was unfolding. He had seen crises before. He had a framework specifically designed for exactly this kind of environment. He was by every measure better positioned to navigate 2008 than almost anyone alive. He made money in 2008, substantial money. His read on the crisis was largely correct. But in an interview years later, reflecting on that period, he said something that stopped people who heard it. He said, "I made money, but I did not make as much as I should have, because I was afraid, not afraid of losing." He had learned to manage that kind of fear decades earlier. He was afraid of something subtler and more corrosive, of being wrong about the magnitude, of looking like someone who was profiting from catastrophe, of the social and reputational cost of being seen to have bet large on the suffering of millions of ordinary people. He sized his position smaller than his analysis justified, not because the analysis was uncertain, because he was uncertain about how the world would see him if the analysis proved correct, and the wins were very large and very visible. This is the mistake nobody talks about, not because it is rare, because it is embarrassing, because admitting it requires acknowledging that you talked yourself out of a correct decision, not for financial reasons, but for social ones. Every person who has ever reduced a position because of what their family might think has made this mistake. Every person who has avoided an investment because it felt too aggressive, too visible, too difficult to explain at dinner has made this mistake. Every person who has turned down a correct call because a full-size position would have required defending it to people who would not understand it has made this mistake. The world does not know about most of the money you did not make. It will not judge you for the positions you were too cautious to take. But the cost is real. It compounds silently over years and decades, and it is paid entirely by you in the currency of a financial life that stayed smaller than it should have been. Soros concluded from this that self-censorship in investing, the internal editing of correct analysis based on how the outcome will appear to others, is one of the most expensive habits a person can carry through a lifetime. More expensive than most visible mistakes, because visible mistakes are bounded by the size of the position you actually took. The cost of the position you never took is unlimited, 5 mistakes. And look at what connects every single one of them. The first, being too early, taught him that time is a cost, and patience is not a virtue when it has become an excuse to avoid admitting you were wrong about the timing. Second, the technology bubble taught him that the eco-investment in a correct thesis is more dangerous than any individual financial loss, because it removes the ability to act clearly at the moment when clarity matters most. The third, the dollar in rationalization, taught him that intelligence is a liability when it is deployed in service of what you already want to believe, and that the rules exist precisely because the mind cannot be trusted to evaluate a losing position objectively. The fourth, the winning feeling after the pound taught him that success generates its own category of blindness, and that the moment of greatest confidence is the moment that requires the greatest caution. The fifth, 2008, taught him that the most expensive cost in a financial life is never what you lose. It is what you never allowed yourself to win. Now, look at those 5 lessons completely outside the context of financial markets. The career you stayed in too long because you had a thesis about how it would eventually improve. The relationship or business you rationalized past every signal that told you to exit. The opportunity you sized down because of what success would look like to the people around you. The momentum from one correct call that made you careless and overconfident about the next decision. George Soros made these mistakes with billions of dollars and a team of analysts and 50 years of experience. Most people make the same mistakes with the only financial life they will ever have, with no team, no framework, and no one pointing out the pattern. The difference is not the size of the mistake. The difference is whether you recognize it and what you decide to do in the 24 hours after you do. If this video changed something, a position you are holding too long, a decision you have been rationalizing, a correct call you have been sizing down because of what other people might think, subscribe. There is a new video every week, and the next one picks up exactly where this one ends.